Hey, my name is Zacc and I'm with Capita Financial Network. We have Laura Hadley with us. She's a wealth advisor with Capita as well. This is your quarterly market update, and we've completely changed the format this time. We hope you like it. We want you to give us feedback. So the reason we've changed the format is due to feedback. So hopefully we hit the mark. If not, let us know. Or if you like this better, please let us know. And that way we can give you more of what you like. Today, the quarterly market update is going to be broken up into 3 different categories. We'll lay that out. In the past, we've had Kurt Brown from Town Square Capital come, and it's been more open and just, free conversation flowing. He usually has 60 to 80 slides, and we don't make it through all of them. It'll be different this time. We have a more structured agenda with things we think you need to know right now. And then we'll have time for questions as well. So if you do have questions, here's a little bit of housekeeping. If you would be willing to drop it into the question and answer. So on your screen, there should be a Q&A button. If you click there and add a question, that'll help Laura and I to know that we're not missing your question. And it gives us a chance to say whether we're answering that live or typing in answers as we go. Laura and I will both watch that. The chat, feel free to use that as well. It's just harder if the questions go in the chat, then we won't know, if we won't be able to track them in the list as easily. I'm trying to think if there's anything else. Hopefully you can see the screen. You should have a blue screen up. Laura, is there anything else you think that we need to go over before we begin?
No, I think we dive right in. There's lots of good stuff today.
Okay. So agenda today is 3 parts. 1, how Capita manages portfolios. 2, current market conditions. And 3, market-related changes to your portfolios. So you'll notice this is pretty different from before. Before we're just spending time on that second bullet point, and we decided today to really bring that home to what's going on with your money and how current markets are affecting your money. So in order to first understand that, though, that's actually the 3rd bullet point. In order to understand what we're doing with your portfolios, we need to understand a little bit more about how we manage accounts, and then look at current market conditions and see how those 2 come together with the 3rd bullet point. So I'm hoping that really helps everybody understand this well.
Hey, Zacc, I'm just watching here. It looks like the chat function is disabled. We just have the Q&A that's working.
I think we can get this figured out. Attendees can chat with everyone. Would somebody be willing to try it? So I just changed it. All right, good. We've done it. We did the format a little differently today, so I'm glad you did that. Laura, will you go through any of them, through the questions, and if we've
most of them were about the chat. We do have a question about TD Ameritrade is safe as a company. Someone heard they were connected somehow with the bank failures we just had.
Yeah, we do have some slides in the current market conditions around bank failures, so let's hit that then. That's great. All right, how Capita manages portfolios. So first of all, let's talk about diversification and what's gone on in the last 2.5 years, roughly. So this screen shows you 2021. It shows you a bunch of stocks. So each of those tickers is an individual company. The size of the box represents how much of the market that stock represents. So for example, we're seeing Microsoft up here at the top. And that's a big chunk of the overall stock market because of how big of a box it is there. And then you also see that these are organized by sector. Sector is like industry. It's the type of business. However, sector is made up of many industries. So about 13 to 15 sectors, 80 to hundreds of industries make up those sectors. So hopefully that helps you understand more about what's going on. But the technology sector is the largest. Technology and financials, make up what is that, like 40%? It's a big chunk of the overall stock market. So you can see that it's some of these big names. This is what they talk about with, the FANG stocks. It used to be Facebook, and now it's Meta. But anyway, that gives you an idea of how big. And it's all green. You can see they did extremely well. I shouldn't say all, right? Some of this communication services didn't do as well.
And the number below just shows the market return for that, let's see, for that year, right, Zacc?
Yes. Yep, for 2021.
Microsoft, Apple, Google had crazy high returns in 2022. We kind of saw it, as we met with you guys, we were showing, look at the returns you're getting in your accounts. And most of the time we were telling you, don't expect this going forward. This isn't always going to happen. And then sure enough, we get to 2022, these same companies. Zach, if you want to flip over to the next slide. The same companies, down 30%, down 22%, down 33%. So quite a change. But then you see, the energy sector over here on the right, it's green, it's doing well in 2022. And so things kind of flipped. And then we look again to 2023. Obviously, we're not through the year yet. A lot of these companies have come back, and then we look at energy and it's back down. So the purpose of these is just to show you, we're not trying to chase what's doing well in the short term. This can be very tempting as an investor. Maybe you see one part of your portfolio doing really well and you're thinking, well, why don't we just invest everything in that? Because that's what's doing well. And a lot of times if you actually do that, you're buying it when it's already up here. So you're buying it at a high cost, and then it ends up coming down and correcting, and you had to feel that loss. And then you're chasing the next highest thing. So you're always selling at a loss and buying high. So we just wanted to show this with you to start off, showing the purpose of why we diversify, why we own a little bit of everything, because it's really hard to know, what's going to do well next.
We had a manager that the company name is Logan there. We're going to talk a little more about managers and how they pick stocks and how we incorporate those into your portfolios. Logan buys dividend paying, low priced stocks. So in 2022, they had a fantastic year because they had a decent amount of energy. They did have some healthcare, financials, and other categories, but they had quite a bit of energy. But for 2020, 2019, years before looked a lot more like 21 in terms of which sectors did well. So they didn't have as great of 2 or 3 or 4 years leading up to that, and then had a knockout year in 2022, and then it's been kind of middle of the road for 23. So these different managers picking different types of stocks are going to have better and worse years, and that's the reason that we diversify. Now, we wanted to show you this because most of you here should have a cornerstone model in your portfolios. So your portfolios, we're going to tell you a little more about the construction of how they work, but a cornerstone model is a portfolio with a little bit of everything. It's very well diversified. It's low cost and very efficient. I say low cost because the underlying funds, when you buy a fund, you are paying an expense ratio. Some advisors will have you buy a fund, and then they charge you the advisory fee, and then they charge you, and then there's built in another % or 2 sometimes on the funds themselves. I'm going to show you an example of this. We believe that if you're really diversified, you should be paying extremely low cost because index funds work great for that. So that's what the cornerstone models are. But look at this, foreign stocks. There's a developed countries fund in your foreign stock allocation that has 2,549 individual developed foreign stocks in it. And then emerging markets, 3,091 positions. Laura and I were talking about this before we came on, talking about China in particular. You would think China would show up under developed countries, but generally it shows up in the emerging market category still. Even though it's a massive economy, it still is part of the indexes for emerging markets. So that's where you get China exposure. You look at bonds, these are the different types. High yield is just a fancy name for lower quality bonds. They have to pay more interest because of their credit score being low. And then short term and intermediate term, those are just how long you have to hold those bonds, carries different risk. If it's short term, usually lower risk. Intermediate term, a little bit more with a little higher interest. A lot of you guys understand a lot of this, so we won't go into every single one. And then this right column represents the size of the companies, as well as whether they're considered cheap or whether they're focused more on earnings growth. And that would be the difference between value and growth. Something we'll talk about later as well is what's called a quality factor. So there are ways of organizing the stock market that are different than what type of stock it is. You might consider organizing the market by factors like dividends that get paid, or how strong are their balance sheets, meaning do they have a lot of debt? Do they have a lot of cash? Do they have a lot of cash flow regularly? Those are more quality factors. And so you're seeing managers have always focused on quality, but you're seeing the market now get organized into factor sets instead of just asset classes. And so we've actually introduced some factor funds within the portfolios. But the point for this slide is, look at those yellow numbers, thousands of positions. So if one CEO makes a stupid mistake, if one company doesn't do well, you're expected to be just fine with these portfolios. So moving towards, and this is Laura. Laura, you said your love of candy brought this out in
I
you.
had to ask because I relate to sugar and candy. And so this is just to help give you a visual. So each one of these containers is a different type of investment, like what we were talking about before. Might be your large value investment or your large growth investment, but inside of that fund, you own hundreds of different companies. And so you're super diversified, not putting all your eggs in one basket. That way, if one part of the market does really well, great, you get a piece of it. If one aspect, does really poorly, great, you only have a piece of it. So this is just to kind of give you a visual, you own thousands of different companies and investments inside of those funds that you own inside of those cornerstone models.
So then there's a different strategy here. So that's all passive. When you hear the word passive, that means like buying an index, being very, very low cost and getting very diversified. But if you want something different than the index, then you need to be semi-concentrated. So not extremely concentrated. That's a problem because you're taking on too much risk. But semi-concentrated actually gives you a chance to perform different than the index. So you can become semi-concentrated. We believe the best way to do that is through separately managed accounts, the acronym SMA. It's a little confusing because it's not like you actually end up with a bunch of different accounts. That's the old way of doing it. They would make you fill out new paperwork. You'd have to open up 6 different IRAs to get 6 different money managers. Nowadays, we have technology where we can take signals from 6 different managers and implement them in one account. There's one of the really neat things that we got here at Capita that I hadn't had in other locations where I've worked in the industry. So this is an example. You take just the slice that you're allocating to US large companies, and in particular, this is a growth manager, a US large growth manager, and Poland Capital is in quite a few portfolios. It's one of the larger SMA managers from whom we get trade signals and implement those stock purchases in clients' accounts. And they are currently signaling that you should own 24 stocks. Way, way different than the large growth fund over here that is 232 stocks. Now, the performance of those 232 is going to be pretty similar to the S&P 500. The performance of these 24 will be related to the S&P 500, but should be quite different because Poland looks at it entirely differently. They have what's called a barbell approach. They like to buy some stocks that are high growth and some stocks that are defensive growth. So we're going to talk a little bit about that, but Thermo Fisher was a recent add to the Poland strategy that is more of the defensive growth, not a conservative stock. It's like of all the growth stocks, it's the more defensive. And Nike has been in that category as well for them. And there are other stocks that they consider to be more high growth. So when markets do really well, Poland tends to do well because of their high growth exposure. When markets do poorly, and like 2008 was an example, COVID was an example where they have some names that are a little more defensive growth. They still go down. They're still related to the S&P 500, but the idea is for them not to experience quite as much volatility. So basically the idea is to get the best of the best candy. And Laura didn't know this, but I have about 4 stashes of Costco-sized peanut M&M containers hidden throughout my house. And they're in different drawers. One's in my office, one's in the basement kitchen, upstairs. I love them. They're definitely the best.
Yeah, that's great. So the idea, a lot of times we'll refer to your SMAs as your individual stock portfolios. So basically that's the idea. We're getting semi-concentrated, picking out what we think are the best of the best companies. So you have both inside of your portfolio. You have your cornerstones, so you get good diversification to help lower your risk. And then we get semi-concentrated, picking out what we think are the best to be able to perform differently than just what the index is doing.
So there's a term for when you're not doing this. It's called closet indexing. Closet indexing is you try to be like Poland by doing something different than the index, but your portfolio looks like an index fund. And the reason that closet indexing is a problem is because, like, this is an example of a portfolio with 370 individual holdings trying to do something different than the S&P 500. If you buy 100 to 150 of the names within the S&P 500, your performance is going to be lock in step or very, very similar with the S&P 500. And then oftentimes the managers charge a higher expense ratio. You might pay something like 0.05 or 0.09 on an index fund. That's shaved off of the share price every day is what we're talking about throughout the year. But on an active fund, it might be a whole percent. It might be 1.5%. I've seen some at 2%, I've seen some at 0.5%, but this one's between 0.5% and 1%. But you get the idea. There's no sense in paying an extra fee in terms of performance because it's shaved out of the performance of the fund for an actively managed fund that looks like an index. So that wraps up the general concept. I want to summarize by saying we believe you should barbell your approach to portfolio design either be very diversified and very low cost on expense ratios, or go semi-concentrated and own the individual positions. The amazing thing about owning the individual positions is that Capita is now covering the expense ratio. I mean, you could go out and buy Poland's mutual fund. It costs about 1.2% per year. But instead of doing that, Capita already buys their trade signals. We find the best managers we like, and then we buy their information rather than sending your money to their fund so you pay for it. We buy their information and we implement those purchases within your portfolio. So SMAs become extremely efficient. And we even find, by the way, that when we implement the purchases in your account rather than sending your money to their fund, it's not just the expense ratio that's saved. There's also cash drag and other investors in the fund buying and selling, forcing the fund manager to take transactions they don't want to take. Whereas if we can just put the stocks in your portfolio, you and only you impact your performance in terms of like buying and selling within the portfolio. So that's called model delivery. We believe we can get out of the dangerous middle of closet indexing if we can get to the two ends of either super diversified, low cost, or semi-concentrated. Now, we need to move on to understand how we construct portfolios overall. And so fire away those questions so we can make sure we cover a lot of them as we go. This is important for you to understand. Most of our clients are approaching retirement or in retirement or thinking about that. When you are within 5 to 10 years of retirement, the order of your returns matters. Before that, it actually doesn't matter much at all. So if you have two investors that experience 30 years worth of returns, but the same numbers just all mixed up, if neither of them are adding or subtracting to the portfolio much, it will end up at the exact same final point. Doesn't matter what order you experience those returns. As soon as you, and by the way, he said, what if you're already retired? This matters as well. The sequence of return risk is greatest in the first decade of retirement. As you get later, the risk of it actually decreases. There are reasons we could explain more on that, maybe one-on-one, but really we call it the retirement danger zone is about 5 to 8 years before retirement, about 10 years after. Your risk of the sequence is less on the two ends. So this example here, concentrate on the black line and the orange line. We took 30 years of performance and went forward through those 30 years with the black line, mixed them up and went backwards with the gray line. And this is a retiree that's withdrawing from their portfolio every month. So they experience the same returns, and one ends up with $6 million at the end, and the other one ends up with $400,000. So you can see that they did the same thing. What were you going to say, Laura?
I was just going to illustrate. So they're taking the same amount out of their portfolio. They started with the same amount. The only difference is the timing of the market, whether we experience the bad years up front or whether we experience them later.
Yeah. And so we can't control that market order, right? That's the most frustrating part. I feel like a lot of people in their working years can just be like, I'll just work harder. But you can only make your portfolio work so hard. You can't actually just put effort into it and somehow change the economy. So that's a difficult thing. That's a scary thing for a lot of retirees. There are a few things you can do. So look at this thing on the left that kind of looks like a hot air balloon. The problem we see is that every single month, if all you do is put certain percentages and certain assets, and then you withdraw from that every single month, imagine that the dark colored area, that black is stocks and the orange is bonds. every single month, 60% of your monthly withdrawals are selling stocks. It's fine if markets are doing great. But if markets have come down and you're selling through downturns, that's problematic. So this is a key reason that we structure portfolios in what's called time-based portfolios versus just percentage-based portfolios. And we're going to talk later about why we set it at approximately these years worth, but the time-based portfolios allows us to take the risk on the long-term money and then really have to sacrifice some growth, but be conservative on the short-term money. And I know this is a topic that everybody understands, but we're going to show you some math behind it and why we structure it the way we do. And it's funny because a lot of financial advisors will tell you, oh yeah, this is your bucket for this, this is your bucket for this, this is your bucket for this. And when it comes time to withdraw, you just withdraw proportionately from everything. Well, there's a problem there. You're selling stocks when markets are down. So executing it is hard too. For example, let's say that overall we started with a 50-50 stock mix. And you said, that's where I want to be. And then we don't know how long a downturn in the market is going to last. So if we keep withdrawing just from the conservative assets, you're no longer 50-50. You might be 60-40 now. And it takes a lot of discipline as a financial advisor to say, this is more aggressive technically because we're 60-40 than what this investor started out as. But we know what we're doing and we're waiting for certain market levels to pull that portfolio back, meaning carve off some of the aggressive and refill the conservative buckets. It's much easier to just say, just take it out of all the buckets and we'll always maintain our 50-50. Anyway, that gives you an idea of like the battle that you're up against when, as an advisor, trying to manage between time-based portfolios and percentage-based portfolios. Anything to add on that, Laura, before we...
I just think that brings a lot of peace because people probably saw that last slide thinking, well, great, we've had some market downturns now. I'm in that retirement danger zone. Well, is this going to ruin my retirement? Do I have to keep working longer? And the answer is no, not necessarily. You know, if we've set up these different buckets and you have a short-term bucket of money set aside that we're going to draw from in the first years of retirement, that means we don't have to sell those stocks when we're down. And that's when it really hurts you. We have time to let those recover. And then when they do recover, great, we'll continue to fill that short-term bucket. So hopefully that gives you some peace and some understanding as to why we set up your portfolio this way.
Yeah. So this first little section, we're wrapping up here. We just wanted to give you some background on why we structure portfolios a certain way, and then it will make more sense as we talk about the exact changes that we're doing relative to current markets. If this type of education and this type of information is interesting to you, Terry Flint and I built an entire ebook. It's 67 pages. It reads like a magazine. It should flow really well for you. It's 7 topics in each category of money and mind. It's meant to help retirees transition and understand the transition or stay in retirement and stay happy in retirement. You can see the pages here help you get a feel for it. It's pretty visual, and we're hoping to make it accessible to everybody. But anyway, scan the little QR code, download it, click on the link. If you ask for these slides, we'll give them to you. Let's move on to a quick update on market conditions. Okay, so within market conditions, we're going to talk about recessions. We're going to talk about inflation, international allocations right now, banking stability, and then within international, we'll cover the concept of the dollar and the reserve currency. That's a huge topic right now. Okay, so I know there's a lot of words here. We're just going to talk. I want you guys to just feel comfortable asking questions. I think this is what most people want to understand is what's happening right now in the market. There is a difference between an earnings recession and the recession that we all fear. So an earnings recession, we actually just went through the second one we've had in the last several years. The first one was during COVID. An earnings recession, so the technical definition of a recession is 2 quarters of negative earnings. We've had that a couple of times recently. So we're experiencing that right now, but it's not the same as hearing of all of our neighbors losing their job and people losing their houses. It doesn't feel the same as it did in 2008 when so many of my friends were I was just watching neighborhoods short sell like crazy. It was a scary time. This is not the same. And in fact, sometimes people don't even know that we went into a technical recession. What they feel is, it's harder for me to find a job, or I'm not getting a pay raise, or groceries are way more expensive, but they don't have quite as much fear. So the question is, why have we experienced an earnings recession? Part of it has to do with coming out of COVID. So coming out of COVID, everybody thought the market would just collapse. And so businesses in general, I feel bad for a lot of big business decision makers because they have to make decisions so far in advance to get the inventory that they need. So they're looking ahead thinking business is going to slow down. People are not going to spend as much. We're headed to a global crisis that could last for 5 years. So they shut down operations, they buy less, their inventories are less. And then all of a sudden, about 3 to 6 months later, throughout the beginning of COVID, people actually did spend quite a bit. And in certain categories, they increased their spending. So businesses got behind on inventory. We all experienced the shortages. People couldn't build homes. I still don't have a dishwasher in my basement. I'm supposed to have a dishwasher in the kitchen in my basement. And basically the kind that was being made back then, I built a house in 2020, they don't even make it anymore. So I have the wrong size of a hole in my cabinets, but you get the idea. That's what was going on. So businesses overreacted from the COVID shortages and they ramped up inventory. So they spent a lot of money, but then people have slowed their spending a little bit with inflation. As rates have gone up, as inflation has gone up, it's a little more expensive for us all. We slow our spending, and now businesses are not having quite as great of earnings growth because they had a lot of inventory they had to pay for and they didn't sell enough. Okay, so the recession, the one you fear, I talked about this already. This is the environment in which everything feels very chaotic. And there's a lot of doubt in the system. And we're all wondering, like, will things collapse? Will these businesses make it out? There are mass layoffs. We haven't had that, and we haven't experienced that yet. And a lot of people expect that we won't experience that same type of massive recession, but an earnings recession could very well likely be the case. And the interesting thing here is it's probably easier for the Fed to manage an earnings recession versus managing inflation. So that leads into inflation. So what's going on here is the Fed has this tight balance they have to manage of, okay, how much do we keep raising rates? How much do we allow money to be easily flowing into the banking system? Because if they allow it to be too loose, then we experience too much inflation, which is a scarier prospect for the Fed than us dealing with an earnings recession. So because of that, Fed's likely to keep rates relatively high. And some of our managers have actually made decisions recently based on, we'll talk about 3 edges being one of them, that they feel like what's called nominal returns have peaked. The amount of interest you can get on your investments is high, but it probably won't go too much higher, but it's not likely to drop super quick either. So the question really is, how hard should they fight like inflation versus allowing the earnings recession, and how do they manage that balance? And they've watched it carefully. They've done I don't want to be too political. Everybody has their opinions, but we have not had to deal with widespread fear of inflation. We definitely have had to deal with, in the last year or two, a decent amount of the normal volatility that comes with the balance between inflation and spending and inventory and business growth and uncertainty of all of that. Anything to add here, Laura? I'm happy to take some questions if you guys want, but the bottom line is it really is up to the Fed to manage that balance. And then it's up to businesses to work through and find ways to be profitable. We talked about it before, Laura. 7% earnings growth is what we've been seeing in this round of earnings reports. And I think we were on a market call earlier today with Town Square, and they were saying that we've never seen, is it negative returns on a year where we started out the year with 7% earnings growth?
Yeah, it's never happened before.
So it's hard. These are hard things. Keep in mind that none of this is a single variable system. I mean, you've got so many variables involved. Let's talk about international, because that leads into that. International for a long time has been viewed as underpriced. This is what international investments have done. This is the MSCI EFA index. It's one of the most common reported indexes for developed world. And this is what it's done since I picked really, really awful time on purpose here, guys. So I picked October of 2007, right before the Great Recession. I'll contrast that with stocks though, so the US stocks, so you can see what's going on. But October of 07 until now is negative 9.9%. And I've been in the industry this entire time and been talking to clients this entire time. And I've been listening to professionals and money managers say that international is cheap, international is a great opportunity. And we're hearing that now as well, but just keep in mind that that's always been the case. But there are three things to consider with international. One, that valuations are better. And two, that there are certain businesses that do better outside the United States, in some cases only exist outside the United States. Tyson Williamson is our investment operations director here. He just lives and breathes this stuff. And he was talking to me earlier about this today: cosmetics and luxury brands, two that exist outside the United States way better than they do inside the United States. For whatever reason, barriers to entry, relationships that they establish, and the high margin nature of them, they just exist and work better outside. Anyway, so the third thing is weakening dollar. Let's talk about valuations real quick though. So this is that same time period, and the orange is the S&P 500. If you took $100,000 and invested it back in October, basically the worst possible time, so that right out of the gate in the last 15, 20 years, right out of the gate, you experienced the worst loss you could, right out of the gate, the S&P 500 still would have given you 266,000. By the way, this particular measurement is not including dividends, which of the S&P 500, the return of dividends is usually about 30 to 40% in some cases. Right now, it's probably a little less than that, but you get the idea. I mean, probably add another $50,000 to $100,000 to that number because of dividends over that same time period, especially if you reinvested those dividends. And then the purple is what you would have gotten out of an international stock fund. So you'd actually have a loss during that time of $10,000. The PE ratio is how expensive the stock is. It's one measurement, probably the most commonly known, but it's not the only way to measure that. It's currently 20 on the S&P 500. We've seen as high as in the 30s over the last 3 to 5 years. Average is oftentimes 15 to 20 and long term. And then the PE ratio of international is 13. So this is what we're seeing, and we've seen for a long time, international being cheaper. The third category is that weakening dollar. So what I mentioned earlier, valuations sometimes are better. I've even heard demographics too. If you think about demographics, younger people in a lot of emerging market countries compared to developed here in the US on average. So more working people. But anyway, so the first one was valuations. The second one is certain businesses exist better outside. And then the third one is weakening dollar. So as other currencies strengthen against the dollar, that gives international investing a little bit of a boost and a better opportunity for those businesses in general. You can imagine if they're transacting across borders or importing, exporting with the US, that favors them a bit if their currency changes. We didn't put any slides in yet on the dollar as the reserve currency. And I feel like we probably just get that question. So let's talk about it. There was a good tweet. I took a screenshot of it or I'll throw this up here. You can see this, right, Laura?
Yep.
Okay. I thought this was interesting. You will only start worrying about the dollar status as a reserve currency when you see long lines outside the Brazilian, Russian, Iranian, and Chinese consulates full of young professionals seeking immigration visas. Fair enough. We're experiencing a weakening of the dollar because we experienced such a strengthening of the dollar for so long. It basically has to weaken to normalize. But I personally, I mean, these are obviously everybody's guessing on these things, but I just don't think that all the news about the weakening dollar is as severe in terms of like, it's not going to lead us to immediate dollar going to not be the reserve currency. I think that the rise of cryptocurrency has created a lot more opinions about like crypto will take over our monetary system. That's been a struggle I actually think there's a lot of really great things happening in the crypto space, but that's been an incredible struggle to gain much traction and much trust in it. And people are still flocking to the dollar. So I think that's about all I would add on that, but we can talk more about it if people want.
So just to kind of summarize for the international, things to be aware of, make sure you're not, overweighted to international, that you still have some exposure to it, that we're diversified, going back, we don't know exactly what's going to happen in the future. Will we continue this trend of international stocks being down over the last decade? Or will that change? Will international stocks be the front runner? We don't know, but that's where it goes back to, being diversified, maybe not being overexposed to it, but having some exposure inside of there.
Yeah, most of the portfolios have been underweighted international for a while, and that's benefited our clients, which has been really good. It might be time to consider a target weight or bringing it back closer to a target weight. But if that helps you all understand that most of us have all had an underweight to international within these portfolios. Okay, so let's talk about banking stability. Mm-hmm. And I'm just going to actually jump to the next slide. If you still don't understand what happened with Silicon Valley Bank, which I think a lot of people are feeling that way, Laura and I recorded a podcast episode. Oh, I forgot to say, Laura is a co-host on the Financial Call podcast. The two of us run that together, and we do this guided education, 8-season program that helps take you from start to finish. Laura does a great job helping bring it home for us on this. And we sat down right after this was going on and recorded it right away. And it's meant to help bring you up to speed so that you can understand the news, basically.
Even if you listen to the first, I think 5 minutes of it, it basically summarized what happened. Then we go on to explain more of the details. But if you just want a quick snippet of what happened, the first 5 minutes of that podcast does a pretty good job of explaining it.
Good point. Okay, so going back to banking stability. So there's this concept, look at the right chart for a minute. I know the circle on the left, that basically that's just saying we're at higher levels of funding in terms of capital ratio, means like how much money the banks have versus how much they've lent out or invested. So we're at higher rates of capital ratios right now than we have been in the past. If you look back at 2008, that was a pretty low time period. Banks were super leveraged. So in general, we're better. Now look over here on the right. These blue bars represent the value of the bonds owned by these banks if you could hold them till maturity and know you're getting your maturity value back. This other color, which Laura and I debated what it is, but it's called brown, like this other brown color, is the current value of those bonds. So if you own a bond that pays out 1% in interest and rates go up to 3%, in order to normalize the fact that bonds out there are better than your bond value will go down a little bit. If rates go up and new bonds are better, your bond value goes down. So that's what's happening.
Sell the bond before it actually matures. When you get your money back, you would have to sell it at a discounted price. And so that's what we're talking about. If you wait till par value, that's what the blue, or the maturity, when you get the money you put in back, that's the value of it if you wait for that time, the blue. But that brownish gold, Davis dark color, it kind of that's if you were to sell the bond now at a discount.
Look at Silicon Valley Bank. So this is called mark to market. When you hear that term in the news, the banks are not required to mark their balance sheets to the current market price of their bonds. So this is why Silicon Valley Bank looked so good under the hood, because they're able to say, oh, those bonds are worth this many billion because they'll mature at that value. When in reality, they were worth way less. The reason that they were worth way less is because they had purchased extremely long-term bonds. So longer-term bonds experience more drop with interest rate changes. So the nice part about this is that you look at these other banks here, JP Morgan and Citigroup and Bank of America, Wells Fargo, Zions is in there. I mean, all of these other banks look more standard in terms of their mark-to-market values versus their maturity values. So it's not as big of a risk for these other banks compared to where Silicon Valley Bank's sat. Now, with that being said, if the entire public market decided they were going to pull every dollar out of any one of these banks within 3 days, that's a risk. That's a problem for any bank to try to pull that off. But had they given Silicon Valley Bank, a month or two, or if people hadn't panicked so quickly, there's a really good chance Silicon Valley Bank could have worked through their issues with maturing bonds and liquidity that they would get naturally. So that's the problem. And this, to me, does tell a pretty big story in terms of the position that SVB was in compared to a lot of other banks. So is the banking system stable is what people are asking. The federal government has basically said that through the FDIC, they would shore it up. I think that banks are going to have to pay a lot more FDIC insurance. It's kind of like when an insurance company for life insurance has a lot of death claims and they realize we need to charge more for these premiums. I think that's going to happen for banks. I think that will impact banks' profits a little bit. One of the things that was interesting in all of the recent events was that they're allowing banks to use the blue bar to pay additional assessments to the FDIC. So even Bank of America here, that half of the value is lost on that bond right there, they can use the full blue bar, even though it hasn't matured yet, to pay those extra assessments. Now, I think that the FDIC has stepped in well. I think that I'm amazed. I actually have a friend that works there. He said it was really hard to close up shop on Friday and then open up for business on Monday. It was crazy. And I'm impressed that all of that happens so fast. There are risks involved. I think buying treasury bonds in a brokerage portfolio, if you're trying to get coverage of like FDIC insurance, you don't get that through treasury bonds, but the same government is backing up those loans. A treasury bond is borrowing from the federal government. FDIC insurance at a bank is the bank is using your money, and then the federal government is backing that. You get the idea. I think it's worth diversifying a bit between institutions if you're using multiple banks, and then using treasury bonds and things like that if you have millions of dollars sitting in cash that at one bank.
But for the most part, if your money's under 250,000, you do have the FDIC insurance, so not a big fear there. But if you have more than that, diversifying or maybe buying treasury bonds or different options there. So just being, aware of what's going on. And I think just real quick, I think the fact that the government came and stepped in and paid back all the deposits on the Silicon Valley Bank, I think it calmed a lot of the fears that people had and kind of avoided the run on the banks. I mean, it's been some time since that happened, and we haven't seen a lot of fear and runs on different banks. So has the problem been, totally avoided? I'm not sure yet, but it seems like, things have been okay and been stable.
Yeah. A question here, a lot of talks about banks, but how do you assess the stability of credit unions? Credit unions tend to be smaller. They tend to be more community oriented. There are really big ones. So it does depend somewhat on whether we're talking small or big ones. This is an issue that is, I think the larger the institution, in many cases, they have some pretty big risk because they have to allocate big blocks of money. So they have to buy things that are really hard to liquidate, that are maybe a little bit longer term. It's a great question, Cheryl, and I don't know if I would consider them that different, but there are some slight nuances because of the community base, smaller size, that in some ways may be more beneficial, but then in some ways could be less because it might be easy for them. It really depends on the management of the credit union. In other words, if even if they're small, they might still be susceptible to these risks because they may have been allocated. And like the problem with Silicon Valley Bank was they had a very narrow client segment, tech companies, startup companies. Those tech companies all needed money quickly because interest rates went up. And then on top of that, they bought long-term bonds. I don't expect a lot of other banks to be in that same situation, but there are other banks that are in some situation. Does that make sense? I hope that you know me, I'm not like, I just want to be real with you, and I'm not going to be like everything's perfect because it never is, but if you keep your eyes open and you want to talk to us one-on-one, we can talk more about that. But I would consider credit unions at the same risk.
And maybe this is a time we can touch on, TD Ameritrade and Charles Schwab being safe as a company. We did get a question about them being connected somehow with these bank failures. And you can touch on this, Zacc, as well. I know Charles Schwab, I think it was 80% of the investments in the cash in Charles Schwab was under that FDIC insurance amount. So they're in a very different position than the SVB was.
I think they were like 10 or 20% FDIC insured at SVB.
Yeah.
And then, like you said, Charles Schwab was in the 80s. But that's one. A lot of the brokerage firms have FDIC sweeps where you put money in one piece and then it can allocate to multiple banks through that one fund. So that's an option. Also, going back to the brokerage firms, you can just buy treasury bonds and the same government's backing up that loan. I like the idea of the fact that many of you own funds and stocks. So even if a big business like TD Ameritrade or Schwab had problems like that, then they don't have to recreate that stock. Whereas the bank has to recreate the money that they lent out to allow you to have it. They don't have to recreate the stock again. It's registered. They just have to say, oh, customer A, you own Microsoft over here instead of over there. And so that makes certain aspects of it a little bit better. But there's always risks everywhere. Hopefully that helps you understand that some of the benefits of owning things through brokerage portfolios. Okay, how and why do we make changes to your portfolio? So you have quite a few people working on your accounts, and we've really done a great job, I think, to help lower the cost of this for you as well. So don't walk away thinking like, oh my gosh, that means layers of cost. In most cases, Capita is paying all of those costs. So we can talk about that as well. But we have teams of people helping out here. And Laura, you had a good way. I was trying to figure out how to explain this. What is the primary responsibility of each of these groups?
Yeah, obviously these overlap a lot, but I'm going to start at the bottom. These individual strategy managers, they're individualing those SMAs, those individual stock portfolios. They're doing the deep research on that. And we'll talk about some of the examples of what they're doing, but they're focused on those different SMAs. Town Square and Orion, they're mostly focused on Cornerstone, those different funds that you have, how much exposure to each one of those funds. So your diversification portfolio, the Cornerstone. And then Capita, we're figuring out, how much allocation do we want to your stocks versus your bonds? How much do we need in your short-term bucket, your long-term bucket? Because we know we know your situation, we know how much money we're going to need in the future. So then we can help, we work together with Town Square and these individual managers to make sure that we're choosing the right investments out of these options to place into your portfolio. So we are all working together, but basically, individual managers working on those individual stocks, Town Square's focused on Cornerstone, and then Capita, we're bringing it all together to personalize it for you.
And this is probably my favorite part, is we finally now that you have the construction of everything, we get to talk about some individual managers and some examples. We just picked a very small sample of a few managers and what they've done during the first quarter of 2023. So this is Poland Capital. I mentioned them earlier. We picked them because they are one of our managers with a bigger allocation. That's because they are a large cap stock manager. They increased their exposure to Amazon, and then they added Thermo Fisher. And I mentioned earlier their barbell approach of owning really growth oriented stocks as well as conservative growth stocks. And Thermo Fisher is definitely one of those that is considered to be anti-cyclical. Anti-cyclical means, when you think markets are doing well, when the economy is doing well, the stocks that just crush it go really fast up. Those are cyclical, and they also go really fast down. Thermo Fisher tends to behave inversely to those. And so they added that recently. We added this slide not because we expected to talk about it or for you to think about it, but this first half is the explanation on Poland adding Amazon, or adding to Amazon. And then the second half is Thermo Fisher. Like, the main point of this is, I'm not sure, but if people know that our teams are looking this closely at these individual positions and managing them for you. Let's give you a different example. This is Alta Capital. Alta manages multiple separately managed accounts for us. We have 3 different strategies that we implement of theirs within your portfolios. They decreased their exposure to Booking. That's Priceline. That's the new stock ticker for Priceline. And part of that is just they've done well. They just took some profits. They just made some money. It's time to not let that get too big in the portfolio. Alta Capital's one of those that is the manager. They say, we don't change our stripes. They tend to be pretty conservative with their stock picking. They're a competitor to Poland. But if you're looking for really high growth, we would do Poland. If you're looking for a more conservative manager that's going to be a little bit closer to the S&P 500, but buy higher quality stocks, that's Alta. And they added Dollar General as well. Okay, so an example of what we would see in your Cornerstone models. So this is not individual stocks. These are some changes that Town Square has facilitated, their investment committee has recommended and done within the Cornerstone strategy. And these changes are just the stock changes. So these go back all the way to the beginning where you saw thousands of individual stocks. What we're talking about is changing between those funds. And we increased large cap exposure, increased high quality. So they introduced a factor level ETF. That's a lot of jargon. They introduced a fund that buys stocks of high quality factors like good balance sheets, good cash flow. And they've increased exposure to defensive business models, and that goes back to like strong balance sheets as well. So those factor sets are something that's happened pretty recently.
I like that. We're focused on buying, really good companies that aren't too high in debt. Their earnings are still looking good. So rather than just really trying to time the markets, we're more just focused on buying you really good quality investments that will perform well over time.
Yeah, and keep in mind, this is within the index portion of their portfolio, right? So like, we're not even talking about the individual stocks, even within the portion that we're saying, just be diversified, get us overall exposure to the markets. We're still even passionately making even just the minor adjustments that are needed to improve the portfolios over there. We need to move quickly because we want to show you a few other things, but within the bond portion, shortened duration in late 21 and early 22. So that means that we shortened how much volatility your bonds would experience, or decrease the volatility that they would experience with rising rates. Now that rates have gone up, now it's time to go ahead and lengthen duration and take advantage of that. So that's been a really good move. Decreased corporate bond exposure, increased government bond exposure. The benefit and the cost difference between there is not as great as it used to be. Like you would expect to get paid more interest for owning a riskier bond that is a corporation versus the government, which would be considered less risk. They call that the spread, or the credit spread, for the credit quality of the bond. The credit spreads are not that wide. They're not as big. So there's not as much of a benefit on the corporate bond. By the way, if you want to understand what's going on in the economy, you don't realize it, but the bond allocators, the fixed income managers, those are the ones that really understand. The bond market's bigger, more money, more issues than the stock market. It's just more complex to understand. Okay, 3Edge is a tactical manager. This means they have a lot more freedom to buy kind of whatever. And we don't have a huge allocation. We're more strategic in our allocations. We believe you shouldn't be too tactical, but they can be a really good strategy for portions of your portfolio that have a shorter time horizon potentially, and we don't want to take on excess risk. They got rid of emerging markets. They increased exposure to gold. They introduced a European stock allocation, and then that was in January, and then in February they increased the allocation to Europe. So European. Yeah, thank you. So I probably won't go into all of the whys. I mean, we do have, I think we got to keep going, but that just gives you an idea of some of the changes. The bottom line is these guys, 3Edge, they use a combination of fundamentals and technical data around things being overbought and oversold, which is a little bit different. A fundamental manager just says, what's good to buy and is it cheap to buy right now? 3Edge throws in a third component to that, saying, yeah, but what are investors doing with it right now? Have they sold a lot of it? Have they bought a lot of it? What is the momentum of the actual trading in that portfolio? Yeah, I think that's probably good on that. If you want to talk more about that, let us know. Rebalancing within the portfolio. This has been on an individual basis. During Q1, we did not go in from Capita and say, everyone needs a rebalance right now. We do that sometimes. But right now, if we don't do that, then it's done on a drift basis or a time basis on each client individually. So right now we're relying more on drift. We haven't seen enough volatility to say snap the line for the entire portfolios. But that means, go ahead.
Oh yeah. I was just going to give a summary of what rebalancing is for those that don't know. So if going back to our allocation, maybe you have 50% stock, 50% bond inside of your account. Well, maybe the stocks have done really well and they've grown. So they're now 60% of your portfolio and your bonds are now 40. Well, we wanted you to be at 50-50. And so what we'll do is we'll trim off some of those stocks, buy back bonds to get you back to that 50-50 allocation target. And the reverse is true as well. Maybe your stocks are doing not as well. Maybe it's a bad year. Maybe it's 2022 or COVID. And your stocks are now 40% of the portfolio. Sometimes we'll trim off some of your bonds and buy back the stocks to get you to the 50-50. So we're basically trimming off what's doing well and buying back what's not doing well, which sounds counterintuitive. But one, it's keeping your risk in line, because if your stocks grow, maybe your risk is now too high for your risk capacity. But also it gives you the opportunity, if you're buying stocks when they're all low, well, when markets recover, great, you get to take advantage of that. And so that's the sort of thing, or that's the idea behind the rebalancing.
Hey, Gloria asked a question, and Gloria, it's a good question. We would need more specifics about your situation, which is probably not good to go over with all of us together. But let me tell you a little bit about how to answer that question. We can talk later. But her question is, if I don't have any bonds, should I get some? And the portfolio has been active since 2019. Okay, so first, if you don't have bonds, but you have some insurance can act, we sometimes will buy insurance like an annuity as a bond proxy. Depending on where rates are, some of them actually perform better than bonds. So we're seeing that right now a bit, but keep in mind, if you have some insurance through an annuity, it may be considered bond-like, and you may not need bonds as well in your TD Ameritrade or Schwab type portfolio. So that's one thing. But looking at these blocks on the right, the time-based portfolios, you should have something conservative. And bonds is a very broad term. It could be 1 or 2 or 3 month bonds and short-term cash-like instruments, or they could be really long-term municipals or corporates or different government bonds. The point is, most people need conservative things for the short-term money. So that question is a really, really good question. And then the follow-up question that we as advisors need to ask you is, okay, what is the time frame on the money? And how have you felt risk-wise with the volatility of it? But hopefully that gives you at least the next step on how to get the answer to that question. Give us a call, since that's one that's more directed to you. But yeah, that next 3 to 5 years worth should. If you have not had bonds recently just because you hated them because they paid so little in interest, fair enough. I can understand that. Bonds are finally paying good interest. I say good, 4 and 5 and 6% rates. So if you don't have bonds and you're thinking about allocating into them, I think now's a really good opportunity for that. Okay, so these bucket strategies, this time-based portfolio, here's the math behind why we do it the way we do it. Here's the reason that we pick approximately these timeframes. So Laura, maybe you can help us, like, what are we looking at here, and why do we think in these 1, 5, and 10-year lines?
Yeah, so this is a representation of the S&P 500, the top 500 stocks in the US, and it's talking about time periods. So if we were to buy an investment and hold it for just a day, the probability that it's going to be positive the next day, 56%, right? It's kind of a 50-50. That's why we don't like to invest in stocks for short term. Over a year, it's actually a 76% probability, which is still pretty good. But a lot of times we'll say, still don't, it's not worth investing everything you need in a year, because there still is a chance there that it could be negative. But over a 5-year period of time, that goes up to 88%. Over a 10-year period of time, you have a 95% chance that those returns are going to be positive. And over 20 years, it's probably a 99.9999% in there. But, historically, over periods of time, the stock market does well over time. So as long as we have enough money set aside in the short term for our short-term needs, it gives you that freedom and flexibility to be able to invest in the stock market with your long-term money, to be able to keep up with inflation, let things recover when things are down. This kind of gives you the same idea, looking at stocks are your green, bonds are your blue, and then a 50-50 mix between stocks and bonds. If you hold it for a year, yeah, you're going to see some fluctuations, mostly in the stocks. But over 5 years, 10 years, 20 years, you have a really good chance of getting good returns in there.
50-50 mix. Anytime, pick any 5 years between 1950 to 2022, and it actually ended up with a positive return. Any 5 years. That's even including some of the worst there with 2008 and 2001 and 2. So I think that's pretty powerful. We've shown this before. Bottom line is, anytime this vertical axis is showing the customer segment or investor segment. Consumer sentiment, right? Is better put. What'd you say?
I don't know if you said segment or sentiment, how people
I
feel.
probably said it all wrong, So consumer sentiment. Thank you, Laura.
Yeah.
The higher on this scale, the more comfortable consumers are. The lower, the more worried they are. And then the blue numbers represent what happens in the S&P 500 for the next 12 months. If you notice, all of the blue numbers up here at the top, or most of them, are lower returns than down here at the bottom. The translation is, when you feel awful, markets usually do great in the next 12 months. And when you feel fantastic, markets do awful in the next 12 months. That's the summary of this slide. Don't let that impact you too much. And this goes back to why we don't time the markets. 7 of the best 10 days occurred within 15 days of the 10 worst. That's the takeaway here. And then if you miss the best 10 days, look at how much of a difference in return you get, 5 versus 9. I want to make sure that we get to the end here, which is we are, and want to make sure you guys have a chance. We'll stick around, but we're right at the hour. So if anybody had something right now you got to go to, great. But thank you. A couple of things. First, while I'm waiting, see if any questions come through. We hope this has been helpful. I think that, we could in the future bring some other portfolio managers in who will be much more technical around their investment decision making, but we thought it might be nice to take a step back and get a little bit away from the finance technical jargon and really say, like, how is it working for you? So if you liked this, please let us know. If you didn't, we will not feel bad at all, because Laura and I spent way more time on this round than we did on the last ones. But we'd be happy to do it again if it's helpful to you, or if you have any other suggestions. While we're waiting, what questions does anybody have? And then we'll wrap it up.
And someone did ask about the link to that Money in Mind booklet. We stuck that link in the chat. So if you missed it, you can click on it through the chat.
Okay. Well, thank you. A lot of you have been really nice about this. You can send your honest feedback later. That was really kind of you, though. All right. I think we wrap it up. We haven't had any or too many questions, but people liked it. Okay. Thank you, everybody.